I want to begin by asking a question, and it's a fairly topical question given the state of the market at present and those sectors that are running. And the question is a fairly simple one. It is this: are lithium stocks a bust? And hopefully you'll have some sort of answer as to whether they are or not by the end of this video. Initially, the cynic in me suggests that they are a bust. And the reason I say this is simple. If you Google the expression lithium stocks, this is the sort of thing you get. It's all sorts of hype regarding what's occurring in this particular segment at present. And if you were to look at any of these sites or any of the other ones that have this sort of overblown hyperbole, you'll generally find it filled with wonderful little graphics like this. And this represents the sale of electric vehicles to 2035, so it's a projection. There is no doubt this is undoubtedly true. Electric vehicles are displacing internal combustion engines and will, in coming generations, be the dominant form of power for all forms of transportation. That's without a doubt. There is no reason to argue against that. What is then occurring from here is that people then look at this sort of chart and extrapolate it to the price of lithium. One of the things we need to know about commodities such as lithium is it's not traded in the same sort of way that traditional commodities such as oil and soybeans and gold and the rest are. It doesn't have the market presence as of yet. And so what we have is this linearity of story where people say, well, electric vehicles are booming. This will drag up the price of lithium. This in turn will drag up the price of lithium-based shares. And unfortunately, when we look at markets, one of the problems with fundamental analysis like this is its linearity. It tries to form a very linear narrative that says, well, A has happened, therefore B will happen, therefore C is obvious. Unfortunately, at each stage between A, B and C, there is an interface. And the interface is humans. And humans do not act in a rational manner. So humans act as a filter. And that filter distorts and alters what your linear narrative might be. But I thought it would be interesting to look at the sort of lithium sector, let's call it that, and see how it's performing. The first issue is actually finding a comprehensive list of local lithium stocks. So initially when I do these sorts of things, I turn to a site like Market Index. Market Index is a very good site, despite what I'm about to say. And I called up their lithium page, and it has this sort of arrangement whereby you get a little descriptor, you get market news, you then get a list of companies. And you can expand that list of companies to a much, much, much larger list. And in this list, there's about 60 odd companies. There's only one problem. They're not lithium stocks. They're people who supply spanners to a company that might be a lithium stock. What we're seeing with these hot sectors is that it's much like the dot-com boom. During the dot-com boom, to take advantage of investor interest, every tiny little dog stock tried to contrive a way to put the expression internet or .com into their name, and so attract investor interest and pump their share price. This happens in the mining sector as well. So the 60 odd shares in this list, and very, very few of them are true lithium stocks. As I said, they're suppliers to companies that are looking for lithium. There are companies that are thinking about looking for lithium. There are companies that have put lithium on their letterhead, just so that they might get some sort of pump in their share price. Having said that though, Market Index is very good for generating lists of stocks that you can sort. and begin to make some sort of general theory or thesis about. And what I've done here is I've expanded their list. And in expanding it, I've got it to sort on market cap. And I've done that simply to present a simple lesson that many people miss. There is a link between market capitalisation, price discovery / liquidity, and the fidelity or integrity of trends. However, we have to be a little bit careful about making that sort of judgment, because you don't know what comes first, the integrity of the trend or the market cap. You don't actually know whether these are stocks that have simply grown to a certain point because of their trend and now they're large, or they're large and then they had a decent trend. So we have to be a little bit careful, but you can actually see that larger stocks tend to have better returns in this particular instance. And I do say in this particular instance. And that's a function of price discovery. Liquidity / price discovery should always be part of your regimen when looking at instruments. Too often, traders or investors are drawn to what you would call shit stocks. And this is the bottom end of that particular list. And you can see here that most of these companies here have a market capitalisation that is less than what you'd be forced to pay for a waterfront home on the harbour. And so to some degree there's somewhat of an embarrassment. And as a tangential whinge, this is an embarrassment of the Australian market. There are some 2,000 listed stocks in Australia. You could probably throw out every second stock because they are such rubbishy little stocks like these. But again, poor price discovery, poor return, poor trend. But with a little bit of hunting around, I assembled a list of what I would consider to be archetypal true lithium stocks. And there's 13 in this list, and I've ranked them initially here by their 2-year rate of change. I picked 2 years simply because this trend began 2 years ago. These stocks began to break out 2 years ago, not this year, not last year, but 2 years ago. And you can see there's some extraordinary returns here. And they are really quite remarkable returns. And so for people who've been involved in this sector from this sort of kick-off point, they will have done very, very well if they'd managed to hold their nerve. And when I go through the stocks, and I've simply plotted these in a little tablet, you get a sense of the order of magnitude of rises they've had. And as I said, they've been quite spectacular. And particularly the best 4 performing stocks all share a characteristic that I'll share with you at the end, and which is an obvious point for people who are in the business of stock picking. And if we scroll through the list, you can see they've all done very well. They all look very, very similar. But you can see something interesting over the past few months. They've started to come off. The exceptional rises that they had have stalled. And so what I did was look at the 3-month returns. So this is effectively almost a year-to-date return. And you can see the handbrake has been lifted a little bit on these. Granted, it would not make much of a difference to you if you had bought Vulcan 2 years ago and in the past 3 months it's down 12%. That's not an issue. The issue is rather whether that continues. And this is the thing, we come back to this notion of linearity. Not only do we form linear narratives, but what happens with traders' assumptions is that they assume, well, I bought it for 1 now, and 4 weeks later it's 10. So if I hold it for another 4 weeks, it will be 100, and then it will be 1,000, then it will be 10,000. That's the idiocy investor expectation, and that's not the reality of how the market works. Even if we loop back to our best performers, you can see they've all come off quite substantially, and you can see that Vulcan, which has been a very good performer, has come off dramatically since the end of last year. So we are back to this notion that nothing lasts forever. But I mentioned that all the best performers shared a feature, and they do. And it's simply this: they had very, very long periods of consolidation before breaking out. And we can point to this as a very generalised feature of all stocks that do well. All stocks that do well have this long-term compression. They then explode out of this compression. And I actually use this as an arbiter of selecting between stocks. The longer the period of compression prior to the breakout for me, I won't say the more comfortable I feel with the breakout, but the higher that individual stock moves up my selection criteria. Traders are often frightened of this congestion, and they're worried about breakouts from it. I actually think you need to take the opposite view and say that the congestion is a very positive thing, because what it's doing is shaking out what in common parlance is referred to as the weak hands. It's knocking out bears who simply can't hold on for that much longer. And so when you're looking at stocks, this sort of thing is a wonderful tool. But given that they have come off, and come off quite markedly, some of them, the question remains, are lithium stocks a bust? And let's set aside my cynical point of view of what Google throws up, and let's default to the evidence. And the evidence from my perspective is yes. This particular part of the cycle has come to an end. Let's ignore the linearity of our narrative. Let's ignore the fact that we make the assumption that electric vehicles are going to take over the world, which they will. These vehicles require certain elements in their construction, and they do. That does not necessarily mean that you will see rampant speculation and price increase in these elements, nor will you automatically see rampant speculation and price increase in companies looking for these elements. You may, as more and more companies search for these things, have a situation where the market defaults to a very, very simple supply and demand model, where the speculative fervour goes out of it. But that raises the question of, given that lithium is not our sort of traditional commodity that you can call up easily or trade easily in and of itself, how do you generate data to formulate some sort of opinion as to what's happening? Fortunately, the good people who create ETFs have done the work for us. And there is actually an ETF that can act as a surrogate for us. And this is a weekly chart, so you can see where this ETF, which looks at lithium and battery technology, took off in January 2020, strangely enough, which is around about the time that these individual stocks begin to take off themselves. So we now have a surrogate, let's call it an index, a market marker, something that will show us sort of what's actually happening in the underlying market. So we don't have to rely upon looking at analogues that are further down sort of this chain of investor interest. And you can use this as your marker for where and when to look. And whilst I have mixed views about ETFs, they do have their purposes, and sometimes someone very clever comes along and builds this sort of analogue for us that acts as an index where there isn't an index, or acts as a surrogate commodity where we might not be able to trade the underlying commodity very easily. But what this chart indicates is something that's fairly obvious, but something that we forget. And that is that everything cycles and not everything is linear. Markets go up and down. Market segments go up and down. The price of shares goes up and down. Irrespective of what your experience or belief structure might be, the law of gravity as it applies to share prices has never been repealed to my knowledge. So just as things go up, things go down. And when we look at broader markets, this is obvious to us. This is something we see. We see that markets have periods of trending, periods of going sideways, periods of drawdown. But strangely enough, when we get involved in stocks like these, that sort of knowledge seems to disappear. It seems to evaporate from our consciousness. There will be people, for example, who bought Vulcan at 8, saw their money double to 16, and who are now still holding it as it falls through $8 again. So they've given up a year's worth of gains because they can't wrap their head around the notion that, yes, they bought it at 8, it went to 16 in a few weeks. It was not going to 32, then 64, and having this endless progression of doubling. And this is where we run into trouble when we try and trade what we'd call hot or popular sectors in the market. And that is that hype often defeats rationality. That we get caught up in the story, and we believe the narrative displaces our data. So that when we see a stock like Vulcan, which we may or may not have been profitable in, start to fall away, we cling to the narrative and won't let that narrative go. And so our rational approach to trading disappears. And we struggle to accept the fact that, well, we've had a very, very profitable market segment. We've had a series of very, very profitable trades. Surely that must continue forever. But unfortunately, in trading, as with everything, nothing lasts forever, and you have to be prepared for the music to stop. And when the music stops, you do want to be one of the people who find a chair.